Okay. Hi, everyone. It's Josh Brown. We are here with William Cohan. You Cohan or Cohen? I'm never 100% sure.
Either one
I'm
works. I
calling you. I'm calling
respond.
you. I'm calling you Bill, no matter what. But
Perfect.
all right.
Thank you.
We're here with Bill, and I've been really looking forward to this. I'm a huge fan of Bill's journalism and his writing. And let me give you guys a quick bio. Bill is an American writer who previously worked as an investigative reporter for the Raleigh Times. He's worked on Wall Street for 17 years as a mergers and acquisitions banker. He spent 6 years at Lazard in New York, then Merrill Lynch. He later became managing director at JP Morgan Chase. But he is perhaps best known as the New York Times bestselling author of multiple books about Wall Street, Goldman Sachs, the fall of GE. He is, in my view, one of the sharpest commentators on what's going on the street. And I wanted to have Bill on to talk a little bit about Goldman Sachs, because I think this summer it's probably the most interesting story on Wall Street. It's a company that reported earnings, not great earnings on, was it Thursday or Friday of last week?
I think it was Thursday.
It's all running together. Okay. So Goldman reported a quarter that you would call a kitchen sink quarter, where they basically said, okay, here's the stuff that is not working out well. We telegraphed this way in advance. We're getting out of these businesses, but here's the red ink. And it almost feels like it's a refresh for the company. But I wanted to get your take on whether or not the rally in the stock since they reported this quote unquote terrible quarter means that Wall Street is willing to give them the benefit of the doubt that the worst is now behind us.
Yeah, I think, Josh, first, thank you for having me. It's great to be here. I think, if Goldman doesn't know how to telegraph, its tough quarter to investors, then
Who
nobody
does?
does. So,
Right.
I think they did a very good job of that, and they kind of, as I say, sort of like a kitchen sink quarter, threw everything in that they could think of that was within reason, and that was negative. You sort of add back those one-time charges, and it wasn't all that different than Morgan Stanley's quarter. I mean, what I find so interesting is, a tremendous bifurcation now going on, at the moment on Wall Street. Between the real depository institutions, the big banks, JP Morgan Chase, that the global banks that also have investment banking, like JP Morgan Chase and Bank of America. They have, basically many of the same problems that Goldman and Morgan Stanley do. And from an investment banking perspective, Morgan Stanley obviously has a much bigger wealth management, asset management business than Goldman Sachs. Goldman Sachs much more geared heavily towards investment banking. Very tough environment in investment banking and trading right now, and I think that you see just like J.P. Morgan Chase putting up $14.5 billion of net income
Yeah.
in the second quarter. On track for like an absurd kind of $15 billion year. And you can see how that happens because they've got, whatever, $2 or $3 trillion of deposits. They pay nothing on that money, literally zero or 0.1, 1 basis point or 2 basis points. So literally they're getting it for free. And then they can lend it out at big spreads, and it just all drops to the bottom line. And, Goldman doesn't have that, obviously. Morgan Stanley has a little bit more of that than Goldman, but not like B of A and JP Morgan do. So you can just see in this environment where interest rates are high and deal volume is low, they're just crushing it.
Yeah, I think JP Morgan is probably not a great comp for Goldman, even though
No,
in
not
name
anymore.
only, they're both considered banks. Morgan Stanley is the better comp. I want to start out by saying I don't even think things are going badly at Goldman Sachs right now. I think what Solomon is going through, the question of whether or not David Solomon will remain CEO through this period, what he's going through is no different than what the leadership at every company goes through when profit distributions shrink from one calendar year to the next, because that's the overall profitability of the entity is ultimately how the partners, it's a public company now, but the stakeholders get paid. And nobody likes to see their pay go down from one year to the next. I think it just is, it's louder at Goldman Sachs than it would be at most companies because of just historically how much money has been made there. And I think that he's just got a similar challenge to a lot of other CEOs, but maybe it's augmented by the fact that it's Goldman Sachs. They're not supposed to have a down year. And then what makes it harder is the Morgan Stanley comp, because Morgan Stanley is on fire in many ways where Goldman is not. Do you see it that way or not necessarily?
Sure, I think everything you said makes sense. I mean, I think look, it's not fair. Well, life probably isn't fair, but I mean, it's not fair to David Solomon. Given the year that they had in 2021, which was just like a blowout
Lights
year.
out. Yeah.
Uh, you know, when I was at Lazard, people used to be given lots of second chances. So if they had one good year, then and not so great the next year, then Michel David Vey would carry them one year to the next. Goldman, they really should do the same thing. They should, combine 21 and 22 and take the average or whatever and say, did I make a lot of money in those 2 years? And the answer will probably be yes. So should I stop complaining? Yes.
Okay.
I should stop complaining because I still get paid more doing this than anything else I can do where I don't put my own capital at risk. And they criticize David. By the way, David has made some decisions about how to deal with the media that I don't agree with. Although he was smart enough to bring in Tony Fratto to try to rectify things, but he himself is not really available, which I think is a mistake. But he's gets criticized for his DJing, his taking the private jets to play golf, to go in the Bahamas.
That stuff is stupid to me, but I could see like the pettiness of people that maybe are unhappy with their bonus. I could see why they would trot that out as part of the issue. It's not
Yes.
really part of the issue.
No, no. I think they probably don't love his style. Maybe he's a little more autocratic than they would like. But the stock, as you said, has performed well.
Yeah.
They are in they're in a sort of a box strategically. They are highly dependent on investment banking and the deal business and a good trading environment in a way that even Morgan Stanley is not, as you said. I mean, Morgan Stanley under James Gorman did a brilliant diversity move that into wealth management and asset management by buying Smith Barney, and Goldman didn't do that. They really aren't they're really not allowed to do much by the Federal Reserve. I mean, there are plenty of strategic things they could do. They've never been very good at their own strategic deals. Green Sky just being the latest example of one that they did that didn't work out. So I don't know why that is that Goldman can't do deals for its own account nearly as well as it can advise other companies. Uh, but
Well, can I ask you about that? So,
sure.
a lot of this consumer banking stuff that is now being, you're seeing losses, you're seeing this stuff being closed down, wound down. A lot of this stuff was not David Solomon, it was Lloyd Blankfein's tenure. And maybe David Solomon was behind the scenes working with Blankfein on it, but he seems to be taking a lot of the blame for things that were in motion before October 2018 when he became the CEO. Do you agree with that?
Yeah, I mean, I do agree that Lloyd, I think, could have diversified the bank during his tenure, and especially after the financial crisis, and sort of take a page from James Gorman's book. But he didn't do that because I think he thought it was cyclical matter, not a structural matter. It turned out to be structural, not cyclical. So
Yeah.
Goldman kind of missed that boat. Yes, and Lloyd also did start Marcus, but David really went sort of whole hog on it, and then talked about, like, in my first, I wrote early on a Vanity Fair profile of David soon after he became CEO, and he was talking about Goldman getting into the cash management business and consumer banking business and doing that sort of in a big time way. And I would say, they
He
still have
doubled down on it.
Marcus. Yeah,
Yeah.
yeah, he's real exactly. They still have Marcus, but they basically have realized the rest of it is kind of like a money losing
I
operation at
want to
this
run
point, and cutting
I
their
want to run through some
losses.
charts with you. Just like very quickly, Morgan Stanley is up 135% since David Solomon took over at Goldman Sachs. Goldman's up 78%. And that, as I mentioned, that's not bad. They've outperformed the XLF, the entire banking sector, which is up about 42% in that time. And they've beaten the S&P, which is up 69%. I would also point out, just in terms of market cap, in October 2018, Goldman Sachs had an $84 billion market cap. Now it's 120. Of course, James Gorman grew Morgan Stanley in the same period of time from 80 to 160, effectively doubled the size of the company. And that's where maybe some of the envy comes in. And it's a little bit of a tougher comp. On revenue growth, again, back to October 2018, Morgan Stanley is a 7% average quarterly revenue growth year over year. And Goldman's actually 10. So, to your point, if you want to just look at 2022, okay, fine, maybe one firm weathered it better than another, but you kind of almost have to take the period as a whole because it was the upside and the downside of a capital markets boom. The last thing I want to do on this, Morgan Stanley versus Goldman Sachs on earnings growth, again, back to October 2018. So Morgan Stanley's growing earnings 25% on average quarterly year over year, which is great, but Goldman Sachs is 31. So we could there's more that we could go through, but I think that the message is you may not love the share price, and obviously there's a big now valuation disparity between the two, and Morgan Stanley's got a higher multiple. I just think people like the strategy that Morgan Stanley pursued. They bought E-Trade, which gives them access to lots of unadvised potential wealth management clients. I think they've made a couple of acquisitions that just make more sense to feed the wealth management machine. And Goldman hasn't done as much of that. They went in a different direction with credit cards, et cetera. It just hasn't worked out as well. And that's where that valuation disparity comes from. Do you see it as just being as simple as that?
Pretty much. And I think that the valuation discrepancy kind of grinds on the OG, partners at
Right.
Goldman, and who have substantial sway at the firm still. And remember it sort of when Goldman was totally king of the hill. So I think if Morgan Stanley is sort of the direct comp, now you've got James Gorman, and James Gorman just pulling off execution trifecta, strategic trifecta, and Goldman sort of left in the dust a little bit. And it's even where, I mean, you correctly peg it to David's arrival, but I mean, if you think back to how close Morgan Stanley came to bankruptcy during the financial crisis, and there was a push to have them merge with J.P. Morgan and reunite the two sides of the Morgan house again. That was resisted mightily by John Mack, and ended up with an investment from a Japanese bank, Mitsubishi, and that sort of, I mean, that talked about one of the greatest investments of all time came from the Japanese in Morgan Stanley at that time. And since then, Morgan Stanley has been on a tear. And I think Goldman is much more dependent on the various cycles of the capital markets. Look, when the capital markets are in their favor, like 2021,
Right.
when the deal business is booming and interest rates are close to zero, I mean, Goldman is like you can't touch the place. But it's the sort of the exact opposite macroeconomic environment right now, and they're kind of struggling. And
You got what?
uh,
So you have in 2021 you had 0% interest rates and you had an IPO every 15 minutes. Now you have almost no IPOs, very little M&A. You have an anti M&A FTC under Biden. So you have like a very small amount of deal making, no underwriting calendar, and interest rates are high, meaning it's expensive to attract deposits. So it's almost like the worst Goldman environment you could envision. It's not going to last forever. and
No, and in
that's just
fact,
what it is right now.
the IPO pipeline is actually filling again because the market has
That's
been
right.
an unexpected little tear here in the last few months. So I think people are starting to fill the IPO pipeline again. There are people who are suggesting that the M&A market is going to rebound. And look, these things are cyclical, and it's been a while. It's been moribund. I mean, I, I kind of laughed to myself at the beginning of the year. A number of media outlets and analysts thought that this would be a big rebound year after last year, and I just did not see it, but at all. And that's sort of definitely it has not been a great investment banking year. But I think, given the market rebound, which I think really surprised a lot of people, and the fact that we have not gone into the much anticipated recession, although, I went on CNN a couple weeks ago and talked about the economy being better than people expected, and I got beat up mercilessly on
People
that.
don't want you to say that. Yeah.
People don't want to
People
hear
do not
that.
want to hear. They don't like it. I
Uh,
don't know why,
they
but they
don't like
don't
it.
like
I
it.
don't know. I said, people are grouchy. People are just generally grouchy, and then I got beat up for that too. So
Bill, don't
there's
say
no
it's good.
winning.
Don't say it's good. Say it's just say it's better than expected. Don't say it's good.
Yeah, right.
Okay.
But the
I want to
truth
ask.
is, it's
Oh,
better than
please.
expected, and it's good. It's
Yeah.
good. It could have been a lot worse.
Well, now they're using the Goldilocks term, which I implore people to not say out loud. It's like it's tempting fate when you start saying this is Goldilocks. But now that we're hearing that, I want to ask you about Goldman's efforts in wealth. If you listen to any bank CEO, any Wall Street bank CEO, any investment bank CEO, and you ask, where is your growth going to come from? Uh, every single one of them will say wealth management. It's almost like asking tech companies, where's your growth going to come from? They all say AI. Like it's almost knee jerk. So, okay, great. So everyone is going to grow their wealth management business? I don't know. Uh, Goldman has always been strong in wealth. And for the people listening to this who do not fully understand what they're doing there, ACO is an incredible business. They basically go to Fortune 500 companies and they uh, are there standing by to deal with the executives, the wealthiest people in America, anything they need from an investing standpoint. And that's a powerhouse business. But they bought United Capital, which was one of the largest RIAs in America, and they bought it in 2019, and they had to integrate it during the pandemic. And just to give you some sense of what they acquired, they paid $750 million in cash. They got 220 financial advisors managing 25 billion in assets, about 22,000 clients. But these are not Goldman Sachs-esque people, the advisors. Not in a bad way. They're not Goldman people. They're RIAs, which are independent and probably didn't show up with a Wharton MBA. And I have to imagine the culture, the integration of one culture with another probably was not made easier by the fact that everything was remote, everything was during a pandemic. But like that's the kind of wealth management acquisition that they've been making. They're also trying to get into custody now, which is not a Goldman-y kind of business. It's very nuts and bolts, very mechanical, low margin, no glamour. So I do think that strategy question, even if the IPO calendar bounces back and Goldman has a good second half in underwriting, I still think they're going to have that discount to Morgan Stanley because I think people from the outside looking at the wealth management strategy are not going to be convinced that they're quote unquote doing it right. What are your thoughts on that?
I mean, Goldman Sachs has the greatest brand name on Wall Street, one of the greatest brands, in the world, and their
Agreed.
inability to get their wealth and asset management business where it should be, blows my mind. I don't understand. Like I said, they've never been good except for Jay Aaron, which was back in 1980 or so. They've never been particularly good at doing M&A deals for their own account. Great
Yeah.
advisor for other people, but for their own account, it's like one botch deal after next, one write off after next. Uh,
Yeah.
I don't really understand it. They should have a superior wealth management business. They should have a superior asset management business. They're constantly changing heads of that business and trying to rejigger it and refigure it. And I don't understand it. And it's not just David Solomon who hasn't been able to get it right. They haven't been able to get it right for
It's
a
a long
while.
time. Yeah.
And I don't necessarily, I think that's something that everybody says because, of course, Morgan Stanley has done, such a great job at that, as we said. Uh, but I don't necessarily see that. I mean, I think they just need. I think they're really at a disadvantage because they just aren't a depository institution. They are regulated like a depository institution because they're a bank holding company, and of course, the Federal Reserve is their regulator. But they just don't have the advantage that depository institutions have at the moment, anyway, for low cost of capital. I mean, Marcus pays 425 basis points on a a so-called savings account. You can get your money at any time. JP Morgan pays 2 basis points. So, I mean, that's a sizable difference in the cost of
So,
capital.
so should they have taken a swipe at one of the larger regionals in February, March, when those stocks were trading an average of 20 to 30% lower because of that temporary blip at SVB? Would that have been a better, if you, like, in other words, you can't halfway be a bank. So if you're going to be regulated as a bank and you want the benefit of a lower cost of funding and you enjoy the FDIC protection on assets, et cetera, why not just actually double down and be a bigger bank? Or would that not have gone over well with shareholders? I don't really know what I think the reaction would have been.
Well, I mean, I've been thinking, for years, and this is something that, John Corzine once contemplated, as I wrote in my book, and it ended up costing him his job, is I mean, and even, I think it's even more true now than ever. They should have bought, merged, or combined with Bank of New York Mellon because that gets them, huge wealth and asset management business. It gets them
Yeah.
Pershing, which is a great business, and it gets them a depository institution and Bank of New York, and it doesn't bring them any investment banking conflict. So, I mean, I
Yeah.
can't imagine, frankly, a better fit. But they either, and by the way, the current CEO of Bank of New York, Mellon, is a former Goldman partner, so I'm sure he would want to do the deal. I get the sense that he would want to do that deal, and it would be a great combination, and it would create a great powerhouse, and it would be a great thing. I think if one of two things have to happen. One, of course, the Fed would have to allow them to do it, and the Fed has been just like it's been 15 years now since the Fed has allowed any of these big banks to do anything, and I'm sure Elizabeth Warren would go bonkers if they tried it. But I think
Yeah.
Goldman needs to do it. And number one is they have to get the Fed to go along, and I suspect the Fed, it's about time for the Fed to relent. And then number two is they have to learn how to integrate an acquisition. And of course, that would be the largest acquisition they've ever done. Can they get an acquisition integration right? I mean, maybe they can borrow Jamie Dimon for 6 months or something. I don't know, but they need to be able to figure that out. Uh, and,
I don't think people,
without that, they're kind of at a loss.
I don't think people understand how deeply ingrained Bank of New York Mellon is to, like, the pipes of the financial system. Like, you talk about systemically important, they might be, like, DL, the most systemically important. Those are the
Pershing.
pipes that were first put together by like Alexander Hamilton. Like,
That's right.
the nothing functions. Like, the ETF market doesn't function without Boney. Like, nothing functions well. What if Pershing? Pershing's like I think, like, one of the crown jewels within Bank of New York. It's the third largest custody platform for family offices, RIAs. It's massive, but it's now subscale because they let Schwab buy TD Ameritrade, and of course Fidelity has gotten much bigger. So now you have the combined Schwab TD, you have Fidelity, and all of a sudden Pershing has become subscale as a result. What if that piece of Bank of New York Mellon could be sold to Goldman. It might be more palatable to regulators as opposed to them buying the whole bank or merging with the whole bank. Could you foresee that as something that is possible at some point over the next year or two?
I mean, I would think that if Bank of New York Mellon, for whatever reason, put that business up for sale, that Goldman would be a logical buyer of it. But I do think Goldman also needs the other pieces. They
Yeah, I
need
do
the
too.
depository institution, and they also could really, I mean, Mellon, you know, which is a great name in wealth management, would be, great. I mean, kind of, it's got it all for Goldman at
Yeah.
this point without any concern about duplicating, in the investment banking uh, positions, which is always a major headache. I mean, when I was at the old JP Morgan before the Chase merger, there were rumors in the summer of 2000 that Goldman and JP Morgan were going to merge. And all of us were just sitting there thinking, well, we're all going to lose our jobs because, we're not going to
It's too
displace
much
the
over. It's
JP,
too
the
much
gold,
overlap.
too much
Yeah,
overlap.
it would have been a bloodbath. This is not
Yep.
that. This is more.
Right.
This is more complimentary. You're saying.
Right. And I think the market would
Okay.
love it. It's not investment advice, but I think the market would love it. And I think, the Fed has to at some point say, look, we've got to do something to make Goldman a better competitor here.
I wanted to finish by asking you how you think this will play out. You ended your piece. You ended your piece today saying, "quote My bet is that David Solomon will figure it out and soon, because if I've learned anything about Goldman Sachs over the years, it's that it usually finds a way of having just the leader it needs at the time it needs him." Uh, and yes, it's always been a him, alas. But if it doesn't have the right person already, it figures that out too. So he's under the gun. He's got to figure this out between now and the second half of the year. All he really has to do is offset this 58% drop in profits from last quarter with something that appears to be going in the right direction. He doesn't have to solve all of their problems, but you seem to think that this is going to go in the direction that it needs to go.
Yeah, I think not only do I sense that from their second quarter earnings, the sort of kitchen sink, throw it all in and get it behind us strategy, but I get a sense from the people I talk to in and around Goldman that there's a lot of noise and needless sort of unrest bubbling up, and I think probably got out of hand. And look, that if David can, assuage the old guard, the OG crowd, if he can get the earnings numbers looking a little better, you're right, he doesn't have to solve it. I think he's going to get help from the macro environment in the market.
Yeah.
I think he'll be okay, but I don't think he's going to have the longest tenure ever at Goldman Sachs. I think he won't get. I think he'll probably survive. There won't be any kind of coup situation, but I wouldn't be surprised to see John Waldron taking over sooner than David may have once liked.
Yeah, I think it's nice if you could name your successor and you can choose at the time of your own retirement, even if it's earlier than you originally would have hoped. It's still that's a better ending than asked
Yeah,
to
more
step down.
elegant. Right.
Yeah, I'm with you. Before we go, let's tell people about Puck and how they can subscribe and what you guys are doing there. I'm really enjoying all of the writers that you have. You're basically covering the way I think about Puck is there's like three major power centers in American life. There's DC, there's Hollywood, and there's Wall Street. And you guys seem to have organized around those spheres of influence. Do I somewhat have that right? Okay.
I think
You're
you have that right. Yes, with a twist
okay.
of fashion thrown in too.
Yes, and you are unapologetically. I don't want to say coastal elite, but you are talking to this audience that not only loves these businesses, but they love the business of the business. And that's the way I've always thought of you and your stuff. You write, I think you're the preeminent writer about the business of business. And that is the perspective that you guys seem to be covering these areas. Can you talk a little bit about the idea behind Puck and what it's becoming as you guys build it out?
Well, first of all, thank you for that, Josh. I mean, that's we started almost 2 years ago, more than 2 years ago now, and I think one of the main ideas was that we would have these verticals, and that the writers who we attracted would get uh-oh would get equity in the business, and that was very important to us as well. And so I left
Sure.
Vanity Fair so I could get equity in Puck, and it hoping that it'll work out well. And we're gonna keep doing what you've described, and hopefully become more of an important business and media enterprise. So I think we're
Are
off
you
to a
having fun?
great
Are you
start.
having fun? Are you enjoying it?
Absolutely. It's great.
All
It's
right.
great. Yes, I love it. And I
Very
love my
cool.
colleagues. They're great.
So I'm a subscriber, and if you guys are interested in checking out Puck, there's a variety of ways that you can subscribe. They've got the podcast is free for everyone, which is how I discovered a lot of the content and said, okay, I want to be a subscriber to this. The podcast is called The Powers That Be, right? Do I have that right?
Yes.
Okay. And how often is that? How often is that going out? Is that a couple of times a week?
Yes, I think that's right. Yeah. With
Okay.
different people participating. Yes.
Different people, of course. All right.
And
My guest today.
articles every day.
You guys are killing it. My guest today is William Cohan. Thank you guys so much for watching, for listening. Check out Puck if you're looking to go deeper in everything from politics to fashion to film and streaming services and Netflix and Goldman Sachs and all of the biggest stories about business. And I think you guys will enjoy it a lot. Thank you so much for your time today, Bill. Really appreciate it. And for people who want to follow you elsewhere, are you on social media these days? Are you doing LinkedIn or
I used to
Threads
be
or Twitter?
called that thing called Twitter. Now it's called X or something. Yes,
It's called
I'm
X.
there. That's my only place.
Okay.
And I have a website.
All right. Thanks so much, Bill. We'll talk to you soon.